Welcome to the 3-Edge Week in Review for the week of December 11th. I'm Fritz Folts, Managing Partner and Chief Investment Strategist here at 3-Edge. And joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss this past week's meeting of the Federal Reserve's Federal Open Market Committee and the FOMC's decision to leave short-term interest rates unchanged. And even though the Fed left rates unchanged, which was widely expected, in the wording of the Fed announcement, and then again in Fed Chair Powell's press conference following the meeting, it did become clear that perhaps the thinking at the Fed has now shifted. For example, some of the wording in the announcement now states that Fed officials now believe our policy rate is likely at or near its peak for this tightening cycle. And that was new language in the announcement, I believe. And then during the press conference, Powell said that, quote, during the FOMC meeting, the members had discussed when they should start cutting rates. In addition, the median forecast in the FOMC's summary of economic projections, which they often refer to as the SEP, that has the Fed funds rate coming down to around 4.5% by the end of next year. And that would equate to perhaps 25 basis point cuts in short-term rates next year. And meanwhile, the Fed funds future market indicates that Wall Street's now expecting up to 6 cuts in short-term interest rates in 2024, which would bring the funds rate down to around 4%. However, to get there, inflation would need to continue to decline at this relatively brisk pace towards the Fed's 2% target, and that is not a sure thing at this point. In addition, this week, the European Central Bank and the Bank of England, they also met. They held their meetings and they held rates steady, but their language was not as dovish as the Fed. So we'll see what the difference will be going forward from here. But both the stock and the bond markets here in the U.S. celebrated the Fed meeting on Wednesday with a broad rally. U.S. equities continuing to reach new highs, signaling the stock market could finish the year on a high note or not. So let me bring Steve in here now. Steve, certainly seems Wall Street consensus, at least for now, is firmly in the belief that the Fed is pivoted, that they're done raising rates, they're going to start to cut rates next year. So perhaps maybe just begin, just talk about how do we get here and why did Chair Powell and the Fed, why have they seemed to pivot at this point in time with inflation still pretty well above the 2% target?
Well, I think this is more impactful than many people might even realize, because up until recently, Fed Chair Powell was publicly stating that he studied the mistakes of the 1970s. He recognized that the Fed declared victory on inflation too early, backed off on their monetary tightening, and that only led to an even worse inflation cycle down the road, in that he vowed not to repeat the same mistakes. So for quite some time, the market believed that interest rates would stay higher for longer, and that was not conducive to the markets. The narrative began to change more recently, and then adding fuel to the fire was a surprising announcement that you mentioned by the Fed in the forecasts of its governors that now, for the very first time in many, many months, they're forecasting not rate hikes, but rate cuts. And that is very unusual historically, because in almost every case, the Fed cuts rates in a response to unmistakable signs of a recession taking root, or a big market correction that shakes everybody up, or a black swan event, something coming out of the blue that really threatens the economy and the markets. So in almost every case, it takes some really bad news for the Fed to relent and say, okay, now we're going to start cutting rates. So this was highly unusual, perhaps more unusual than many think.
Excellent. All right. So now I think it would be helpful to discuss how, even though the equity markets celebrated the perception of the Fed's pivot this past week, I know there still are a number of potential risks out there that investors need to be aware of. So maybe if you could walk us through those risks.
Well, I'm going to share with you what I think are the two major risks. Obviously, there may be more, but one is inflation itself, that inflation might actually bounce back and not go all the way down to 2%. This narrative of immaculate disinflation is really taking root among investors, but it's certainly not guaranteed. And then second, investors have been behaving as though the recession has been averted. There will be no recession, at most a soft landing. And of course, that's not guaranteed. And what if the recession has been delayed by all the fiscal stimulus and all the consumer spending in the lag from the monetary tightening we had already? And what if it's just delayed and eventually we hit the recession? So going back to inflation, and going back to the 1970s and even the 1940s, there were two major periods that were similar to what we're going through now, where inflation picked up and spiked in a very unexpected way, and then began to fall. Governments and central bankers declared victory on inflation, and it stayed low for a few months, and only to then take root again and go even higher. So it happened in the 1940s after World War II. And it happened again in the 1970s. And as you can see in this chart, we're tracking this pattern quite well. And again, we're declaring victory on inflation. Again, we're talking about rate cuts. And this might prove to seem accurate for some time, just like it did in the 1940s and 1970s, until the structural causes of the inflation start to pick up again. And why is that? And why did it happen before? And why could it happen again? It's because the very act of taking your foot off the brake and adding support again, lowering rates, et cetera, will loosen financial conditions and then unleash all the structural causes that brought inflation in the first place. That's what happened in the 40s, it's what happened in the 70s, and it could happen again. Next is on the recession. We looked over the last 150 years, how many times have we had a yield curve that's been this inverted? And by yield curve, we're talking about short-term 3-month Treasury bill rates compared to the longer-term 10-year rates. Inverted means that the unusual case that the short-term rates are higher than long-term rates. How many times have we had the yield curve inverted as much as it's been and for as long as it's been, and we've avoided a recession? And over the last 150 years, the answer is 0. So for the investors' idea of the Goldilocks economy, the soft landing, the immaculate disinflation, et cetera, in that we're avoiding a recession, for that to come true, it would have to be the first time in history that it's ever happened in the U.S. And we're not saying it's impossible, and there are other factors that are extraordinary, like the extraordinary fiscal stimulus that's been unleashed in the economy. But we're saying I certainly wouldn't want to bet all of my eggs in the one basket.
Absolutely. Excellent. All right. Great. Thank you. So as always, final question. Based on what we've discussed here today about the Fed pivot, the possibility of rate cuts in 2024, what might investors consider in terms of adjusting their own investment portfolios in this environment now?
Well, certainly there's been a very bullish risk-on response to the Fed meeting, immediately after and for the next couple of days. And we've seen the S&P 500 index, which has been outperforming just about everything in the world, really ratchet higher. But I'd like to remind everyone that we're only back to where we were 2 years ago. And when we were talking about overvalued markets 2 years ago, we've only made it back to that level. So we've really gone sideways in 2 years. It just seems like the market's taking off. And there's no law in finance that says overvalued markets can't become even more overvalued. So we could see this rally continue. But our view is that as long as the narrative is that we're going to avoid recession, and recession, maybe we didn't avoid it completely, maybe we just delayed it, but as long as that narrative continues, it's a chance for certain undervalued asset classes to begin their period of catching up because they've fallen behind so much. So just a couple of examples. When the Fed was hiking rates, the dollar was strong, bond yields were going up, that's a serious headwind against hard assets in emerging markets. Hard assets, think gold, emerging market equities, have underperformed greatly since the financial crisis of 2008. All of a sudden now, bond yields are coming back down. The Fed's talking about easing. The dollar's weakening. This is a big tailwind to those asset classes. So time to look at some undervalued asset classes that have underperformed that could catch up as long as this narrative continues. And that would be emerging market equities and gold. Another example, the Japanese yen, their currency has seriously weakened over time and is deeply undervalued on a purchasing power parity basis. And now, suddenly, there's talk about the Japanese doing away with their yield curve control and their negative interest rates, talk about the Fed cutting. Well, this has caused Japanese yen to start to appreciate again. And we think companies in Japan that are not necessarily export-oriented, but more domestically oriented, like small cap companies, are very undervalued and can benefit from all of that. And if you invest in those without hedging the currency, you can take advantage of the yen appreciation. So that's another area. Third, within the U.S., not every U.S. stock index is overvalued. We talk about U.S. stocks being overvalued, but we're talking specifically about the S&P 500 index. You can think of the S&P 500 index as a large cap growth index today because tech so dominates the index. So what is the opposite of that? The opposite of large cap growth is small cap value. The valuations on small cap value are much, much more reasonable than the rest of the U.S. stock market. Small cap value is underperformed over time. And over long periods of time, it trades places between outperforming and underperforming. So it could be a chance for those stocks to catch up. And then finally, in the bond market, we think TIPS, Treasury Inflation Protected Securities, have a great chance to catch up. The market is already anticipating that inflation is going to come down close to 2% and stay there. And the real interest rates are falling. So with TIPS, you lock in 2% yield plus the rate of inflation, which right now is running a little over 3%. So that's 5%. Plus, you get additional capital appreciation if real rates continue to come down. So we think that TIPS are a good place to look at as well.
Excellent. Great. Thank you. Thank you very much for your insights today, the implications for the apparent Fed pivot, and the implications for the markets going forward into 2024. Never a dull moment in the global capital markets. So that will do it for Steve and me for this week. Programming note, since the next 2 weekends will bring us right up to the Christmas holiday, followed then the following week to the New Year's holiday the following week. Today's video will be our final 3-Edge Weekend Review video for this year, but we'll be return on Saturday, January 6th. Before we sign off this year, we'd like to thank our listeners. Steve and I, we put a great deal of time and effort into creating these videos, and we do it because we think it is important to inform and educate our listeners on topics that are timely and in a way that goes beyond what we hear on the financial news networks every day. And although I'm pretty sure we're not going to win any Emmy Awards, Steve, sorry about that, we're grateful for our listener base. It's grown larger than we ever could have imagined when we started creating these videos at the onset of the global pandemic. So thank you all for listening. We're grateful. And so until next year, on behalf of Steve and everyone here at 3Edge, we wish you and your family all the very best for the holiday season and the coming new year. And as always, thanks for listening.